Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Time to start. The comments on the last three exhibits are going to be brief. Oil's better because of the prospect of Israeli missiles directed at Iran export facilities. As I mentioned last Wednesday, that seems to be a bit unlikely because Iran has made it clear to Saudi Arabia and Abu Dhabi that if their Israel puts missiles into Iranian export facilities, Houthis or someone are going to put missiles into Saudi Arabia and Abu Dhabi's oil export facilities. So I think the likely outcome is that oil will stiffen a little, but don't think we're going to have very high oil prices because of the surplus capacity. We estimate here it being in the range of 4 million barrels. I redid the 25 forecast over last weekend, and there's somewhat less demand from China. You can see China's kind of flat, 25 versus 24, and the rest of it is more or less the same. I know I've pointed this out before, but your mature economies like the U.S., oil demand just does not grow very much. Look at U.S. in 22 is 20.3, and 25 the estimate is 20.6. Europe in 22 is 14.3 million barrels, 14.2 in 25. Japan, 3.4 in 22, 3.2. So to get oil demand to grow by 1.5 million barrels a day, we're very dependent on places away from the developed economies. I guess one of the ways to look at this is not that the Chinese economy, the second largest economy in the world, is slowing down. It's just become more mature. So you need the growth from other places. And it seems to be happening. If we look at OPEC numbers or IEA numbers, the problem is that growth isn't enough to cut in too much to that surplus capacity. And OPEC and the other members, Saudi Arabia, other members of OPEC, a pretty carefully structured program to start introducing about half of that surplus capacity into the market starting in December. They do it over a year and a half or so, and maybe that will work, but that is certainly a concern for oil prices. The natural gas page, Exhibit B, has been substantially revised over last weekend. The production remains the same at 105, and as we see, that is really important. And remember, in November of 23, the production was 104, so some flattening out, like going only 101.8 in 23 up to 102, is producers, especially two producers in the Marcellus, E2T and Chesapeake, holding production back. Canadian imports have gone up a lot more than I would have guessed. If you look at that line in 2019, it was 4.3, got up to 5.5 in 22, down a little in 23, but back at close to 6 for 24 and 25. I can't really give a cogent reason why that's so, except I guess Canadian gas producers are willing to take a lower net back. Power demand, you can see 21 versus 20, it was actually down, but power demand's been going up 1.5 per day per year, which is good because LNG feed gas, which was under 6 in 2019, got to 13 Bs last year, was flatlined in 24. I do think it's going up in 25 based on projects that will come on, but that has been disappointing. The surplus, in other words, the difference between supply and demand, got down to a B a day, which would be about 350 Bs a year in 20, And look what happened to gas prices. I mean, in 21, it was 370. We actually went into deficit. And then gas prices with the Ukraine war and concerns about Europe having to make up for Russian gas got to $6 in 22. Gas is going to average about 260 this year. But the worrisome thing is down at the bottom, October 18th, which is last Thursday, the prompt contract was 227. I mean, that's an impossible number for this time of year. And the whole 25 strip came down. I have it here at 320, but it's probably closer to 310. And that's down in the last 3 or 4 weeks by 30, 40 cents. Part of that is the nice weather we're experiencing all over the country, warmer than normal for late October. Part of it is forecast for the winter being warmer than normal. Partly it's just a great deal of surplus gas and gas and storage. And it is worrisome because, it's not, especially in the last 3 or 4 weeks, not behaving very well. Exhibit A, we promised to stay away from politics. These are really remarkable numbers. And I think whoever's elected on November 5th is going to have to deal with it. 24, and these are 11-month numbers from the CBO, Congressional Budget Office, just under 5 trillion in revenues, just under 7 trillion in spending. Think of it. The difference between 5 and 7 is 2, or a little less than 2. That's the amount of money we borrowed last year. I mean, that is just not sustainable. And in fact, over the past 3 or 4 weeks, the 10-year bond, kind of the base currency for that maturity worldwide, has gone from 370 to 420, up 50 basis points. Part of that may be stronger economy and thinking that the Fed funds rate is not going to come down again, the next Fed meeting, by 50 basis points like the last. But I think part of it is just concern about financing the deficit, because you have to finance that $1.9 trillion, but at the same time, the Fed balance sheet is being brought down by about $0.5 trillion a year. So it got as high as 9. I think it's down to 7. So $1.9 trillion plus $0.5 trillion, which probably should be $1 trillion of quantitative easing to get the Fed balance sheet down for when we need to have the Fed come to the rescue again. Interest rate is a price, like the price of eggs or the price of gasoline. I mean, if there's more demand for government treasuries and there is supply of money to buy them, the interest rate will be high. I know Mike and Jason now agree that this is not sustainable, but any additional comments, Jason or Mike?
Yeah, I think we agree also that it's the financing our debt that's raising the rates in the last couple of weeks.
Yeah, and the threat that maybe the only way out is through inflation.
Yeah, for the first time in a long time, these are all cut up with the earnings results. This week's version, page 13, the banks report the earliest. And this is JP Morgan, Morgan Stanley, Goldman Sachs, and we've added Interactive Brokers, which also reported last week. So these are 9-month numbers. They're all pretty good. We focus on free cash flow. JP Morgan, which is the largest, has $57 billion of free cash flow, trading for about 12 times free cash flow or an 8% yield. I mean, I guess you'd say it's a stable business, not one that's growing a great deal. Morgan Stanley and Goldman Sachs are perennial competitors. From a free cash flow point of view, in a bit of a surprise, you can see Morgan Stanley has more revenue at $60 billion versus Goldman Sachs at $52. But when it comes down to free cash flow, Goldman Sachs has a beat, $19 billion to $15 billion. Also, Morgan Stanley trades at a higher multiple times free cash flow, around 13 versus 10. I would say Morgan Stanley has more of a continuing business from their wealth management, where Goldman Sachs tried to enter some kind of more retail-facing businesses and lost money and has decided, has pretty well completed divesting those businesses. So Goldman Sachs is basically a trading firm, an investment banking firm. Interactive is a firm that a lot of you may not be familiar with, but it's where most active investors keep their accounts, including Mike and Jason. It's much smaller, of course. It has $3 billion of free cash flow. If we go down to seeing what happened in the interim reports, Morgan and Goldman Sachs, Morgan Stanley was flat, and part of that is the impact of earlier acquisitions. When West Coast banks got in trouble, JP Morgan came to the rescue, and so those things generated a lot of income. So the year-to-year comparisons are difficult for JP Morgan. Morgan Stanley and Goldman Sachs free cash flow growth during the 9 months are, in the 30% range. But that's kind of recovery. The one that grinds it out, kind of compounds the free cash flow, is Interactive. With that, I'll pause and see if Mike or Jason have anything to add on the banks.
I would just point out on Interactive, if you're interested in learning more, we did have one of our interns this summer wrote an article on the background of the company and the founder, which you can find in the archive of our site.
The other company updated over the weekend last weekend because I had the interim report was Netflix, which is on page 4. I didn't have Disney, Meta, or Spotify. And Spotify is a new entry here that Mike and Jason may want to speak to when we have the 9 months results, or in Disney's case, it'll be the 12 months results. They're a September year. Netflix continues to do pretty well. We think of them as, being challenged, having to spend a lot of money on content to maintain their subscriber base and whatnot. But, the results are pretty darn good. I mean, their free cash flow is growing. They're expensive, but, not too expensive at 30 times free cash flow. Disney is the one where they have had some changeovers in management. It's interesting, the former chairman of Morgan Stanley became chairman of Walt Disney, and Bob Iger had to come back as CEO, as not the chairman anymore. One of the things the board has announced is that Bob Iger will have a replacement in place by beginning of 26. He accomplished it so far productive for the stockholders transition at Morgan Stanley. So if you can do the same for Disney, that would be great. That is a little out of place here, I guess, as a media stock. Maybe they should be on page 1. Spotify is an interesting company. Mike and Jason were at a conference where Spotify was featured. I think it's a company that we all will probably spend a little more time on. It is expensive, $1 billion of free cash flow, and and a market cap of $72 billion. But without getting into anything more on Spotify, turn it over to either Mike or Jason, who although they've just barely started their work on it, they're better able to describe position, moat, whatever we want to call it, that Spotify has as compared to competitors.
Other than being a happy user of Spotify, I kind of wrote it off a while back for investment purposes. And as you said, we're starting to look at it closer again. Mike, do you have any more?
Well, yeah, let's one of the interesting things about the business model is that it's got a very strong, I guess you'd say it's a network effect, in that all of the content is on Spotify and most of the users are on Spotify. So you would be crazy as a recording artist not to put your content on Spotify, because that's where the majority. It's become a winner take all market. Spotify's business just records revenue, and then its costs are basically split out pro rata to all the different artists on the platform. So it has a fixed, call it operating margin. And maybe it's about a third, maybe a little less than that. So the challenge is they don't have a lot of drivers to increase revenue except to get more subscribers or raise the price of the subscription. But for every dollar they raise a subscription, they might only get a third of that. So, the question is, how do you better monetize, or is your growth just constrained based on population that you're able to access? What we learned in the event, or whatever, the interview with the CEO of Spotify, is that they're slowly working their way into video because they're watching what happened, or what's happened with YouTube, and trying to figure out if that's a place that they can make a play. I think their challenge will be that their current compensation model is, well, it's effective. It may not be as detailed or pointed as maybe a competing model could be. In the case of YouTube, you're going to get credit for the subscribers that use YouTube Plus and the advertisements that are shown during your clips. So it's hyper relevant to the performance of your content. In the case of Spotify, Taylor Swift can do really, really well, but if Spotify revenues go down because subscribers go down, then Taylor Swift doesn't do quite as well, or vice versa. I mean, you could look at it from the fact that it's harder for something new to break into Spotify than it is in maybe some of the other platforms. So all that is to say is the big thing in these media content things is how do you properly incentivize the creators and charge a fair price to your consumers? And Spotify so far bridged that gap to be the only dominant player, and thus far has really fended off Apple's competitive product in the space.
In the remaining 10 or 12 minutes or so, I'm going to introduce the subject, and then we'll turn over to Jason and Mike, especially Jason. But I've become interested as an investor in who is going to be able to have a Siri-like device in the home, in your, access by your iPhone, where you speak, you ask them to do things for you, and they come back in a conversational tone pretty quickly, because that seems to be what these AI models are able to do, is be quick, maybe not accurate, but quick, and come with a response, converse with you, maybe backed up by text. Now, as Mike and I have talked, in our 20-minute calls, Monday through Friday mornings, I've realized that that is not just around the corner because of the inaccuracies, whether it's OpenAI or Google products or Anthropic. So the question for Jason, and Jason might talk all day, but Jason and I only talk on Wednesdays. Jason, how long, or what needs to happen, or is it possible so that a conversational directive to a software, I guess you call it, doesn't screw up, that doesn't need guardrails, doesn't get your calendar, doesn't get your appointments wrong? What do you foresee there?
Well, I'd say all software screws up, and so do all people. So, but I think it's imminent that we have some of these AI tools that don't make the mistakes as we've seen over the last year. There's a couple products out released in the last couple months. Google's is called Notebook LM. It came out, I think, of just a few weeks ago. Amazon has one as well that they don't market at all. But in these tools, you can load your data into them, and right now they're not focused really on the consumer, but you can load documents into these tools, and the answers are directly related to the content in the documents that you put into the system. It doesn't make up other things that are unrelated to the data you put in. And in my experience, it's been accurate. If If not, though, it's not complete information. So it might give you an answer it finds in one or two of the documents, but doesn't take into account all the information that you've loaded into it. But one thing I think they're erring on the side of reducing errors versus giving you more complete answers. So they're still feeling out the process, but they're working through it so that these AI tools don't give you incorrect data. So these are more business focused tools today. I think that's how they're doing their experimentation, and the consumer ones will be coming shortly, without a doubt.
To add to that, I think it's important to make a distinction between a specialized agent and a generalized agent. And when we think about something that we as consumers interact with, it's almost definitely going to be a generalized agent. You think of Siri as a generalized agent, albeit a very bad one, but it has a few things it does well, like set timers. But you think about ChatGPT, which has the built-in chat feature, and you can speak to it and it will respond with voice. That's a generalized agent. It's not generally very good at a lot of things, though it can do all the things that ChatGPT has been able to do, which is pretty impressive. But I think what we'll see over the next, and what Microsoft is pushing with their AI Copilot Studio, and some of these other companies that are all building agents like Salesforce, you'll see specialized agents as probably the earliest form factor. And like Jason said, Amazon and some of these others have ways to dial in the actions of the agent and what it does in a way that reduces the likelihood of making mistakes, and also creates the guardrails within the system so that it maybe will throw an error, if you will, like a traditional software program, if the output isn't quite what is expected. So all this to say is we may be waiting longer for something generalized that's as capable as we may dream of. But
I suspect we're not waiting that long. And the reason I say that is I think we will have this collection of specialized AI agents, and then there's going to be a generalized one that's trained on how to talk to those specialized ones. So it's maybe a middle layer between you and the specialized agents, and then I think there won't be really a distinction from the end user's point of view, but it's kind of delegating the work for you. And I think once we have the specialized agents, taking that next step's not that difficult.
Absolutely. And I think that sort of gets it's sort of like developing a software program and using an API to request that an action is taken and return a value. So an orchestration agent has a lot of value in making something more generalized and more useful.
And Apple's kind of alluded to taking that model with their Apple Intelligence. I don't know how it's progressing, but their hope is that app developers will create that API into Apple Intelligence, and then you can use Siri or whatever they call it to then be that interface into the app. So we'll see how that goes. I think it kind of gets rid of the incentives of you creating an app in the first place, but they'll figure out a way to make it work.
Who would you expect to make the most progress? Or put another way, if we go to page 1, Apple and Microsoft are more or less in the same neighborhood in terms of valuation. So who, and let's say let's just look. Maybe these numbers may be out of date, but Apple was about 3.4 trillion. Microsoft was around 3 trillion. Since both of them are working hard on this, which one do you think will add, $1 trillion to their market value first, or which one will get to 5 trillion first between Apple and Microsoft? If you had to guess, Jason.
If I had to guess, it'd be Microsoft. I think the case, the business, the case of these tools in a business setting is more clear today. And Mike has a good example of some of the AI tools they recently showcased with their work with McKinsey. But I think that's more kind of well understood versus how the consumer is going to want to interact with an AI agent. And then the pricing and the savings to the company makes a lot more, the business case for it makes a lot more sense in Microsoft's case.
Yeah, there's immediate value to be unlocked with Microsoft. I totally agree that Microsoft's probably more likely. Now, Apple in the long run, if they set up a platform where Siri can ride on top and then access applications and other agents to do specific things, if they make that vision real, there's no reason to expect that they'll be disrupted. It would take a completely different solution and approach to knock them out. And so I think they often say we're not always first, but we're best. So this is a very well-resourced company. You have to expect that they're going to come up with a very compelling solution, and it may just be slower than we'd like to think it will be.
Jason, suppose everyone decides they need an iPhone 17 or whatever the product is. The pace of new iPhone sales goes up, which is still, despite all the services, still at least half of the free cash flow in Apple, I think. Would Apple win the cash flow race, but Microsoft beat the market value race?
That's a good point. They very well could. I think everyone kind of expects the iPhone upgrade cycle has permanently slowed down. So if that reaccelerates, and if there's compelling improvements to the iPhone every year, where that you might want to upgrade annually or at least every 2 years, that kind of changes the equation. The value of each customer will go up by, I don't know, call it a quarter?
Yeah.
Potentially.
If you look at the other free cash, Amazon always lags in generating free cash. They're different. Their retail, their business, their delivery business is capital intensive and lower margin. Do you think there's any way for either Amazon or Alphabet to keep up with that kind of progress if Microsoft is able to make the case to business owners and Apple is able to get a much quicker upgrade cycle? They would probably leave Amazon at around 50 billion in free cash flow and Alphabet around 60 billion of free cash flow in the dust.
Yeah, I agree. Yeah, they're operating in two different businesses. It's much lower margin to sell consumer goods and then compute resources.
Right.
I don't think Amazon's famously kind of like Costco. They intend to only lower the price of compute in AWS, so they're going to outprice everyone else if they can.
Okay, let's take a quick break for a message from Oak Cliff Sailing.
This is a Wednesday update for Oak Cliff that I didn't expect to be giving, but I am on the top of the Empire State Building and we're about ready to do some yoga courtesy of Athleta, and the Women's Sports Foundation Gala is tonight. Really proud that Kimbra and Mark Walter, who sponsor Courageous, are going to be honored tonight. So I'm playing hooky from Oak Cliff and I'm really excited to share with you this beautiful, beautiful sunrise here in October. See you soon back at Oak Cliff.
And now back to the show.
We skipped over Meta. Meta seems to, we review how everyone's doing, including the private companies, the OpenAIs, Anthropics, and XAI. You can make a case that Meta's have done better than any of them in terms of their approach to AI. And they're kind of in the 40 billion free cash flow. Now Meta's proven pretty adept at monetizing their other products. If you lined up Meta, Amazon, and Google, and you were kind of like Mike and I, if you're running a sailboat race, which one would you over the next 3 years say? Which one would you think would create the most increase in free cash flow?
Ooh. Well, did you say you said the next 3 years?
Yeah.
Okay, next 3 years. I would take Meta out of that equation. Probably Google. I think they, kind of similar to Apple, they have a huge install base of Android phones. As long as they don't get broken up, and the penalties from the DOJ aren't too bad against them. They're going to be able to leverage marking up, taking some rake on the AI tools going through their app store as well. And that could be a huge new economy of AI agents that they get a cut of. Longer term though, I don't know if it's the smartest bet, but I would put my money on Meta. I just think they have some interesting opportunities, and Mark Zuckerberg's shown that he's willing to adjust his strategy with his whole AR/VR division, his Reality Labs division. They kind of started off as the VR goggles, and now they're moving into these augmented reality Ray-Ban glasses. And Ray-Ban says that's their top selling product now. The reviews of these glasses are all great. I haven't had my hands on them yet, but that seems like that's kind of like where the augmented reality product right now is going. And they're probably the leader in that. So if that becomes a kind of a standard piece of technology that everyone's going to adopt, they have potentially the next iPhone.
Right. We've run out of our 30 minutes. Be here exactly 7 days from now. We promised to get through the Magnificent 7, 8, 9, whatever. I think we still have Netflix to do. So once we pick up some more data on the competitors, we'll see if we do Netflix next week. Take care, everyone. Stay well and be healthy. Bye-bye.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.